Section 4. Financial planning for buyers of distressed properties. Evaluating risk before entering a distressed property transaction. Purchasing distressed real estate, whether through foreclosure, short sale, or auction, can present strong investment opportunities, but it also introduces a higher level of financial and legal risk. Unlike traditional transactions, these properties are often sold under pressure, with limited disclosures, and in as-is condition. For this reason, buyers must approach these transactions with a disciplined strategy that includes property analysis, financial planning, and risk mitigation. Real estate professionals play a critical role in guiding buyers through this process and ensuring they understand both the opportunity and the exposure involved. Understanding property condition and as-is risk. One of the most significant risks when purchasing a distressed property is the unknown condition of the home. Most distressed properties are sold as is, meaning the seller or lender will not make repairs or provide warranties. This creates a situation where buyers assume full responsibility for any defects discovered after closing. For example, a buyer may purchase a foreclosure in Phoenix for $150,000, believing it only needs cosmetic updates, only to later discover structural issues or roof failure costing $40,000 or more. To mitigate this risk, buyers should always attempt to conduct inspections, even when not required. This includes general home inspections and, when necessary, specialized inspections for mold, pests, or foundation issues. Recommending inspections aligns with a licensee's duty under AAC R428-1101 to exercise reasonable care and protect the client's interests. Financing challenges, unique to distressed properties. Financing distressed properties is often more complex than traditional home purchases. Many lenders are hesitant to finance properties in poor condition, and certain loan programs may not apply. As a result, buyers must be prepared to explore alternative financing strategies. For example, a buyer interested in a heavily damaged property in Mesa may not qualify for a conventional loan and instead must use an FHA 203K loan to finance both the purchase and repairs. Alternatively, investors may rely on hard money loans or private financing, which allow for faster closings but come with higher interest rates and shorter repayment terms. In some cases, foreclosure auctions require all cash purchases, eliminating financing entirely. Understanding these limitations upfront helps buyers avoid delays and failed transactions. Title, liens, and legal risk exposure. Distressed properties often come with hidden legal risks, including unpaid liens, property taxes, or judgments that may attach to the property. Unlike traditional sales, these issues are not always resolved prior to closing, especially in auction scenarios. A failure to identify these risks can result in significant unexpected costs for the buyer. For example, a buyer who purchases a foreclosure without a proper title search may later discover a $20,000 tax lien that must be satisfied to clear title. This is why title searches and title insurance are essential components of risk management. Real estate professionals should strongly encourage buyers to work with title companies and, when needed, legal counsel to fully understand the property's status before closing. Market analysis and investment viability. Beyond the physical and legal condition of the property, buyers must evaluate whether the purchase makes financial sense. This includes conducting a comparative market analysis, CMA, estimating repair costs, and projecting the property's value after improvements. The goal is to determine whether the investment will produce a reasonable return. For instance, if a buyer purchases a distressed property for $180,000 and invests $50,000 in repairs, the total investment is $230,000. If comparable homes in the area are selling for $240,000, the margin for profit is minimal and may not justify the risk. However, if the after-repair value is $300,000, the investment may be worthwhile. This level of analysis is essential, particularly in fluctuating markets where property values may change during the renovation period. Hidden repair costs and budgeting for the unexpected. Distressed properties frequently come with hidden repair costs that are not immediately visible during initial walkthroughs. These may include plumbing leaks, HVAC system failures, electrical hazards, or structural damage caused by deferred maintenance. Buyers must plan for these risks by building contingency funds into their budget. A practical rule is to add an additional 10% to 20% above estimated repair costs to account for unexpected issues. For example, if initial repair estimates total $30,000, the buyer should plan for a total budget closer to $36,000 to $40,000. This approach helps prevent financial strain during renovation and ensures the project remains viable. Negotiation strategies in distressed transactions. While many distressed properties are sold as is, this does not eliminate the opportunity to negotiate. In short sales, lenders may be more willing to offer price reductions or credits to facilitate closing. In foreclosure situations, negotiation is more limited, but pricing may already reflect the property's condition. For example, if a buyer discovers that a property requires a $15,000 roof replacement, they may negotiate a price reduction or request concessions if the transaction allows. Understanding the seller's position, whether it is a lender, investor, or distressed homeowner, can help shape an effective negotiation strategy. Risk assessment tools for investors and buyers. Sophisticated buyers and investors rely on specific tools to evaluate distressed property opportunities. These include financial metrics such as net operating income, NOI, and capitalization rate, cap rate, as well as market analysis tools like CMA and repair cost projections. These tools allow buyers to quantify risk and determine whether the investment aligns with their financial goals. For example, an investor purchasing a rental property may calculate NOI by subtracting operating expenses from rental income to determine profitability. If a property generates $2,500 per month in rent but costs $1,500 per month in expenses, the NOI is $1,000, providing a clear picture of income potential. Strategic decision-making and professional guidance. Ultimately, successful distressed property purchases require careful planning, realistic expectations, and professional support. Buyers should work closely with real estate agents, inspectors, lenders, and attorneys to ensure all aspects of the transaction are thoroughly evaluated. For real estate professionals, this is where expertise becomes critical. By guiding clients through financial analysis, disclosure considerations, and risk assessment, agents not only facilitate successful transactions, but also reduce the likelihood of post-closing disputes and liability. Online discussion questions. Why is purchasing a distressed property considered a higher risk than a traditional transaction? Answer. Because distressed properties are often sold as is, they may have limited disclosures, potential title issues, and unknown repair costs, increasing financial and legal exposure. How can a buyer protect themselves from hidden repair costs when purchasing a foreclosure? Answer: by conducting thorough inspections, obtaining contractor estimates, and budgeting an additional 10 to 20% for unexpected repairs. Why is a comparative market analysis, CMA, critical when evaluating distressed property investments? Answer: a CMA helps determine whether the purchase price, combined with repair costs, aligns with the property's potential market value and profitability.